Hello everybody. We have recently come out with a report on Ganesh Benzoplast, that is GBL, and the company is into providing services for petrochemical companies, oil and gas companies in the form of liquid storage terminals. They have got tanks at various ports like JNPT, Cochin and Goa. JNPT is their biggest port with about a capacity close to 3,03,000 kiloliters, followed by Cochin and then Goa. The main business is LST business, and equally proportionate business is of chemicals division. Chemicals, they manufacture preservatives for food and pharma companies, and also chemicals for automobile companies. And this business is about 50% of the top line, and LST is 50%. So LST is a much profitable business with margins close to about 35 to 40%, while chemicals division margins are quite erratic. But the 9-month chemical division's margins, EBIT margins, are close to about 14%. LST is close to about 35%, and going forward we are expecting a good jump in margins based on higher LST business expectations, because during pandemic the company has especially done better on the LST division as well, because they are earning rentals from companies like Bharat Petroleum, Hindustan Petroleum, Indian Oil, Reliance, etc. And especially because of their services, uninterrupted services during the pandemic, they have earned better margins as well as revenues. So going forward as well, if the pandemic continues or if it doesn't continue also, the company is expected to perform well on this business. The second main or the most important factor is the company is demerging both of these businesses, LST as well as chemicals, and that is expected to unlock a lot of shareholder value. So this is one of the biggest drivers that is we are expecting. The third thing is that they have done an acquisition of a company called as Stolt Engineering, which is into movable LSTs, that is LSTs which are used for railways, and these LSTs will be used for transportation of oil and liquid from ports as well to the consumer's doorstep, and it's a high margin business, so we are expecting good margins from here as well. And overall, if you see, the company is in process of debt reduction. The company the company's net debt to equity now lies close to about 0.2. Gross debt to equity is about 0.3. The company is doing very well on cash front. This net debt to equity 1 year ago was close to about 1x. Now it is quite reduced because of the better or the improvement in operations and the increase in the cash flows as well. Then if you see, it's in a lesser capex mode as well. Most of the capex is behind them, and strong margins as well as strong balance sheet performance the company is doing. And overall, if you see, it's on a very strong wicket right now. The pledging, which was a major concern for the investors earlier, the company is behind it because they have unpledged each and every share which was pledged earlier, and that has happened in this particular year, last year. So overall, there are no overhangs on the company, and now the future will be mainly driven by the operations, and we are expecting a good move on the operations as well. So recently we came out with a report on it with a target close to 100 rupees. So from levels of 60 to 63, it's looking really very attractive. So one can get into it. Thank you.